morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The coronavirus death toll touches 1,112 patients as new cases are reported from cruise ships across the Asian region. US Federal Reserve Chairman Jerome Powell warns that the outbreak is bound to impact US and global growth. Arvind Kejriwal retains his chief ministership in Delhi as the Aam Aadmi Party wins 62 out of the 70 assembly seats. The Congress draws a blank yet again, with 63 of its candidates losing their deposits. Coal India manages to meet estimates despite a drop in both revenue and profits in the third quarter. Lower alumina cost may end up hurting Hindalco in its third quarter earnings, even as cost measures help Novelis post higher bottom line. Well, let's take a look at the trade setup for the day. It was a ho-hum day of trade for the US markets. Yes, they managed to eke out record highs, select indices, but as you look at the close, it was a flattish close. The Dow very, very flat. I mean, you can call it marginally in the red. The S&P 500 and the Nasdaq too very flat. So not a big day of trade for the US markets at least, but Asia has a bit of optimism to itself. Whatever is operational in Asia has a bit of optimism to itself. And we have the SGX Nifty 2 looking at a start, which is about 0.25% in the green. The key is though, if you just look at what traders across the world seem to be doing, there is also a bit of bet against the Chinese equities in the offshore markets. And this is a chart that is there on the Bloomberg terminal, which shows a couple of things. One, how bears are continuing to bet against the Chinese stocks via US ETFs. So that is part one, and the volumes on these bets are much higher. So both of these things you got to keep in mind. There's also a chart which shows how these bets have actually inched up. So one, that the bets are increasing, and two, they are happening at a much higher volume as well. Both of these lead one to believe that there is some bets being taken against the Chinese equities. Maybe, just maybe, for now the equities are holding out, but select set of people believe that at some point of time they will give way. Let's wait and watch. For now, we take it a day at a time. And what is today's day showing? Well, maybe some bit of optimism that we are likely to see in our markets as well. As I said, the SGX Nifty is anyway showing that uptick, but buoyed no doubt in part by what the rest of the Asian world is doing as well. So we had an uptick yesterday. We might well continue that in the session today. The other key thing within our markets, one, that we'll have a start in the green, but the other key thing that you got to monitor is that LME has shown a surge in lead, in copper, and because base metals have shown that bit of an uptick, we might well have the Nifty Metal index do reasonably okay in today's session as well. So do watch out for the metal stocks in this session. Other reason for watching out metal stocks in Hindalco in particular, the numbers come out today. There's of course the Novelis numbers, but Hindalco numbers come out today. So I think we'll watch out for that stock in particular. And some other very interesting numbers. IRCTC's really been on fire. That comes out with numbers today. So a very important set of numbers, as also RT Industries. The stock has shown a major rebound after those income tax inquiries. And then there's PI Industries and Info Edge. Both of the stocks are trading very close to record highs. So it's very interesting to see if indeed the numbers delivery from each of these is actually strong or no. But what are the stocks that you're watching out for in the session today? Well, 3 or 4 that I think are the most important ones. We'll of course have Coal India in focus because of the results, but BHEL, I thought it was important. Revenues down about 22%, EBITDA up about 49%, but the net profit came off about 17%. Now, amongst other brokerages, Macquarie's come out with a note on BHL, and I want to bring it up right now because I thought the note said something very interesting. They believe that there are radical changes needed to cut the fixed costs and diversify revenue streams, without which survival of BHEL might be unlikely. Now, I don't know if the street would view it as negatively, but the clutch of brokerages have kind of raised these alarm bells for BHEL. Let's wait and watch if this reacts negatively today. HEG, we know that the numbers are going to be bad, but this is a really poor performance. Net revenues down 78%, EBITDA down 99%, and therefore the stock has posted a loss of 1.2 crores versus a profit of 865 crores. Just tells you that if the commodity cycle turns in select stocks, you don't even know the extent of the damage that could come in. Or it'll be very interesting to see how HEG manages to survive a scare in the session today. On the other hand, Astral Poly, yet another company wherein the revenue numbers were not that impressive, just about 5.4%, but EBITDA and margins were good, and the net profit was up about 30%. I think the anti-dumping duty on CPVC resins imported from China and Korea aided the margins for Astral Poly. Let's see if this one reacts positively. Novartis, poor set of numbers. Margins got impacted due to higher employee expenses. Yes, it's an MNC, but because of the shoddy performance, you might see some reaction here. And I would watch out for a couple of things. One, JSPL. There is an event that could happen today which could change. Remember, Wollongong coal hearing is today, and if there's any restructuring of the international debt, it could improve JSPL's cash flow situation, and maybe the street might like that. So do watch out for this one, and do watch out for the Nifty rebalance. MS has come out with a note. They are saying that there are likely inclusion candidates, including Dabur, Shree Cement, and the 2 life insurance companies. So maybe the street might want to align itself a little bit to these. And likely exclusion candidates are Z Entertainment and Yes Bank. Shouldn't surprise people really. Let's see if this indeed happens. And if this happens, by the way, media moves out of the Nifty completely. Nifty 50, that is. Okay, let's tell you what's lined up on First Word today, the collection of the top editorial stories that we want to bring to you. Sajid Pangat first tells us what's helped portfolio managers beat benchmarks in the month of January. Did banks actually go and lend a whole lot more in the third quarter as prescribed by the government? Vishwanath gives us an answer. Nikki takes us through Coal India's earnings and the highlights thereof. And then Darshan wraps up First Word by taking a look at Honeywell Automation and its track record on the bourses. 2020 started off on a rather optimistic note for the broader markets and for portfolio managers. The average return for the top 50 portfolio management services in the country is way higher than the Sensex performance in January. Sajid is here to take us through the details. And Sajid, needless to say, it has to be the mid-cap and the small-cap rally that would have aided to performance.
That's right. We saw that rally beginning mid of November onwards when we saw mid-cap and small-caps coming back into flavor. At the end of December, we had some of the fund managers talking about that 2020 would be the year when you'll see some kind of money shifting back from the large caps to the mid-caps. Remember, in 2018-19, we saw because of the liquidity crisis, even if the mid-cap had a good business model, people were selling it off and then moving to defensives or blue chips, and that as a result of which there is a valuation jump for many of the blue chips there, because all the money was flowing into those 10-20 stocks which was part of the index, and and were considered slightly defensive and safe for money. We've seen that money now churning out of those to some of the mid caps where for the last 2 quarters we have Q2 and Q3 we've seen decent mid 20% jump in earnings on a year-to-year basis, and that has led to valuation jump for many of the portfolio managers which were banking on mid cap and small caps to see the healthy returns coming in the month of January. So if you look at the average return for portfolio managers, which we track for 60 portfolio managers in January, they had an average return of 2.8% compared to a benchmark Sensex in Nifty, which has fallen 1.3% and 1.7%. The mid-cap, NSE mid-cap 100 rose 5.3%. So and many of the good top portfolio managers which had more than 80% concentration in small and mid cap saw their returns jumping more than 6%. One of the portfolio managers 2.2 which is Amit Mantri's fund, they had a return of 8% in the month of January itself, and in the last 3 months they had more than 15.4% return coming in for the fund itself, which is double the return given by NSE mid cap 100. NSE mid cap 100 had around 7.1% of return. So the reason being, many of the BFSI space in the mid cap have started seeing fund flows. What we were seeing in 18-19, a lot of flows were going into some of the NBFCs like the Bajaj Finance, the Bajaj Finservs of the world, because they were, and their valuation was getting rich. Now that is now shifting to some of the other NBFCs, especially the gold NBFCs, gold financing NBFCs like Muthoot and Manappuram, where gold prices have also gone up, and that has aided their company's performance as well. So we've seen a shift happening. What Amit Mantri says that even though that is the case, the risk-reward ratio is still not favorable, because while his own fund on an aggregate basis sitting on 12 to 13% of cash, the new portfolios, the new clients who are coming in, their portfolio is sitting on more than 40% in cash. And the reason being that many of the mid caps which had extreme valuation ahead of before the liquidity crisis, their valuations have now come down to expensive but still not cheap, and so the returns are not favorable for.
So you're saying people are sitting on cash?
People are sitting on cash because either they don't have stocks to invest in, or they are so expensive that you still want to take a call whether you want to, ride a small jump in the stock valuation, because these stocks have fallen 30-40% from the peaks, but they're still on a rich valuation which is there. Like 2.2's portfolio, their average 12-month trailing PE is around 17 times, which is a decent PE for the entire portfolio of 12 stocks. But he still says that many of the mid caps which he has are at expensive valuation and not cheap enough.
Yeah, but as most people have stated, Shankar and Ramdev both stated, it's a market wherein you buy expensive and you make money, you buy cheap and you lose money. Let's wait and watch if that actually stays true. But Sajid, very interesting work. Thanks so much for putting that into perspective. January has been a good month for portfolio managers, and a story around this would be on our website. So do try and log in and read more about this, as also most of the other things that we speak on First Word. Well, the other thing that we want to speak on First Word is about Coal India, which reported a decline in both its top line and bottom line. But this was largely on expected lines. Now, Nikki's standing by with the fine print of the numbers. Nikki, I know the dividend was the bigger story here, but the numbers too. And approaching the numbers, Coal India stock had declined about 6% odd. Did the numbers live up to the billing?
Yeah, it was inline set of numbers, pretty much out of the textbook. Nothing changes for the company. But then, yes, what brokerages make out is definitely a better outlook coming in for the company. Dividend this time around hasn't come through, but then the expectations don't die there. They're expected to come in the coming week. We can expect some amount of dividend, a large chunk of dividend rather being released from Coal India, which is obviously also supporting, would expected to support the stock performance today. But then overall, greatly inline set of numbers. Nothing changes there. But I'm going to take you through the top line performance. 7.5% downtick, 23,190 crore is the number, top line number. EBITDA, we've seen a 26.8% decline, the number sub 5,000 odd crore. And the margins have contracted to 21% as compared to 27%. And profitability, that number has also declined by 14% to a number less than 4,000 odd crore. What goes behind the making of these numbers is the flat realization and the higher operating expenses. When I talk about operating expenses, it's a combination of both employee expenses as well as contractual expenses. With as a percent of your net sales, they've gone higher. Profitability to an extent has just declined 14% as compared to more than 27% decline that we've seen in EBITDA. That's on account of other income, which to an extent has aided the bottom line performance. But then look at the volume performance. That's the most dismal picture that we've seen, at least for e-auction volumes, which have been the lowest that we've seen in the history of Coal India. And also volumes that have come down by 33%. It's the weak thermal demand and the extended monsoon overall, which has weighed on the overall performance of Coal India. And realization rupee per ton, that has also taken a hit, essentially driven by or impacted by the e-auction realizations, which have come down significantly by 8%. And FSA realization, they too have taken a hit. But the blended realization, to an extent, they are pretty much flattish on account of the stable FSA realization that we've seen.
Okay, so what have brokerages made of these numbers, Nikki?
So brokerages, typically they've retained their outlook as well as the target price. They're hoping for better Q4 to come through. What Edelweiss Securities says that while maintaining the buy rating and the target price of around 250, they say that e-auction premium jumped to a 3-quarter high, but volume slid to lowest ever. FSA realization inched down owing to grade mix, and they see higher potential of great dividend payout in FY20. says that the stock is trading at an undemanding 5.9 times FY21 estimated EPS. JP Morgan also reiterates the same thing, says the valuations have been lower. They expect the dividend to come through, expect a better performance coming in Q4, and the stock is now trading at excessively cheap valuations. Prabhudas Leeladhar also maintains the accumulate rating and expect a better show. They expect the FY21 weakness in e-auction realization to be offset by strong availability due to higher production. Now, back in January, also things have started turning around for Coal India when it comes to production numbers. That is expected to aid the performance going forward. And now they're talking about valuations which are at all-time low level, EV to EBITDA of 2.5 times, and pushing the dividend yield to near highs of 9%. So that's one bit of positive for Coal India overall.
Okay, we'll watch out for Coal India in the session today as also over the next few days, because as Nikki said, maybe the dividend expectations don't quite die down. The stock in the run-up to the results hasn't done too much. In fact, it's been down about 6%. Let's see how it reacts today. Thanks for that, Nikki. Well, with the economy slowing down, the government has been announcing several schemes, and RBI's easing liquidity to coax banks, especially the state-owned ones, to lend more. Has all this effort shown results is the key question, isn't it? Now, Vishwanath Nair has done the number crunching to find out if credit growth truly picked up in the December quarter.
The second half of FY19 as well as most of FY20 has gone into banks being pushed towards higher lending towards retail and MSME growth, with the government having provided about 70,000 odd crore worth of additional capitalization. This is over and above the 2.5 lakh crore that they have given since FY15. All of these measures are expected to boost the credit growth for a public sector banking system, for the entire public sector banking system. Has that resulted in what it was looking out to do? Well, if you were to look at the aggregated data for the public sector banking system for Q3 of FY20, that is the October-December quarter, that seems to be showing some results. For the entire banking system, public sector banking system, which consists of about 14 banks that BloombergQuint has looked at, the overall credit growth is about 7%. Of course, this is only on an aggregated level. If you were to look at individual banks, then out of the 14, only 5 banks have reported 7% or higher worth of credit growth. Most others have reported a lower credit growth than that, actually subpar growth, with 3 banks reporting negative growth on their loan books. Primarily, the reason for the slower growth has been the slower offtake with the corporate lending scenario, with companies not even utilizing the limits that have been extended to them by the banking system. This, combined with the fact that banks have been writing off large amounts of corporate loans from their books to maintain their asset quality, has resulted in a lower than expected credit growth for most of the banking system, especially on the public sector banking side. Analysts are pointing out that going ahead with the recent announcements that have been made by the government, especially with respect to the MSME restructuring scheme, as well as the announcements that are made by the Reserve Bank of India, where banks do not have to maintain CRR against certain retail as well as MSME loans. All of these measures are going to help banks post a higher credit growth figure. However, of course, that would depend still on how the asset quality situation plays out.
Well, the question mark only is that with the policy that went by when most people said that has Das done a Draghi, a couple of headlines like that, will this policy lead to a change and a higher lending to sectors that really need the money? That's the question. I think the same thing, when we do it in the month of April or May, might have some different numbers as well, or change numbers compared to what the numbers are right now. Well, let's wait and watch. Let's not preempt. Okay, the last piece on First Word is about a company that has rallied more than 40% this year. In fact, this stock has consistently delivered stellar returns, Honeywell Automation. So what's working for this company? Darshan is standing by to tell us. Darshan, we know MNCs have done well, but Honeywell Automation is probably in a league of its own in the last 1 month.
Yeah, so a couple of things worked, and in a situation where you saw how BHEL came out with numbers, how Siemens disappointed yesterday, Honeywell came out with strong set of numbers, and a lot of things that were said in the budget worked in its favor. So a couple of interesting points that you need to watch out for. Obviously, it's up 40% this year, but look at what's happened since December 2020. So in the past 20 years, it's up 200 times. So for a stock which is almost 38,000 rupees, that to move 10% every day for the past few days is indeed stunning. That shows the confidence that it is there. Now, basically what it does is, just to give you a business profile of what the company does, it's basically into automation and control system, caters to oil, mining, metals, power, and the entire smart city grid that they do. That is something that is positive. They have said that they want to get into more pharmaceutical and healthcare industries also in terms of automation. So wherein there is modernization that is happening, Honeywell Automation is one of the companies that is there. Now look at the internals. It has a market cap in excess of 33,000 crores. The promoter holds 75%. Hardly any debt. Cash of almost 1,400 crores on the book. So no problem at all as far as the balance sheet is concerned. Clean international MNC company. Promoter has 75% stake. Now look at the return ratios that the company has been throwing. Very strong, 13% on asset, but on equity and capital more than 20%, which is very, very good for a company, or at least in a company which is into capital goods and has to do a lot of capex. Now look at the financials, what they've thrown up over the past few years. Look at the revenue. The revenue has moved in from 650 crores to 900 crores. So consistently they have been performing, and from the first quarter 2018, when they did a 55 crore, they managed to triple their revenues in a matter of 2-3 years. So there is enough traction. So the financials speak for itself. But they've been able to continuously increase their margins and gross margins also, which is also good. Now, if you're looking at the gross margins, again, they had slacked a little bit, but now again back at the 49 mark. But look at the EBITDA margin. From a 12% in the first quarter of 2018, they moved to almost 21% currently. So there is a lot of positive things that are happening. First of all, what is aiding the margin? Both on the export front and the domestic front, there is enough positive traction. The export is a high margin growth business for them, and the revenue CAGR for the past 5 years is a 24% CAGR on the export business. So that is doing well. And domestic also, even though the CAGR may be low of 11%, the domestic business managed to turn around in the last 2 years. So that is where a lot of positive traction comes out.
So, Darshan, the history is looking very solid. They have expanded margins, expanded profits. What's the outlook going forward? And can we compare it with some peers? How does it stack up?
So it's managed to do much better than the peers. I think ABB will come out numbers today, so we'll come out to what it does. Siemens yesterday probably disappointed. Let's take a look at some of the things that the management does. It doesn't speak openly, but on the annual reports, they did manage to give some positive cues, and some analysts also reported. So first of all, there is demand for pharma products, for product process automation. That is what they had said. Smart city and digital initiative to aid building solutions. Now, if you look at what happened in the budget, there was a lot of emphasis on smart cities, where we connected to Schneider Infra. I think Honeywell is the bigger player here, and it has been doing well consistently. It's already working on 3 smart cities. It's completed, and 7 are already in process. So it's a big player in there. The other things that is there is railway modernization, metros, new airport growth areas with the Udan project that the government has announced. There is a lot of traction there, and industrial Internet of Things adoption is poised to increase, is what they say, and across the board, be it any industry, there is Internet of Things that is happening. So that is something that is working. Now, you asked about the peer comparison. Look at how they've managed to move in the last 1 year. Honeywell Automation, clear outperformer compared to, even though Siemens and ABB have given positive returns, Honeywell Automation has managed to outperform with a 78% return that is there, and majority of the move has come in the last 1.5 months itself. In terms of how they have performed in terms of valuation, and there Honeywell Automation in the December quarter, good revenue grew 11%. ABB results will be out today, but we took the last available number. That was the September quarter, where they fell in 30% with margins of 7%. Siemens yesterday saw revenue decline of 5%. The management commentary was not there. Even though ABB and Siemens are cheaper compared to automation, but look at the margin difference that ABB or Honeywell has compared to the others. In terms of valuation, no doubt it's expensive. On an FY20, it's 70 times. On an FY21, it's 60 times. So not too much brokerage coverage on it, but the Bloomberg consensus does indicate that even after at the 38,000 rupee price, there is still a potential upside of 5%.
It's very interesting, Darshan, that in the same space, Honeywell Automation, both on the return ratios as well as the EBITDA margins, is able to do much better than its peers. Surely they're doing something right or something which is slightly different than its peers.
Yeah, so basically they got a lot of emphasis from the recent push on infrastructure, at least on the smart city, because they've done 3 cities, 7 are on the way. There is a lot of emphasis on automation. While you know, it's not a direct apple to apple comparison, because ABB also is into, you know, power equipment where Honeywell is not. Siemens also has that thing in that, but nevertheless we're comparing multinational to multinational, which also have a component of in the digitization in terms of automation. That's this, and I think the majority they've been doing well for the past few quarters, and they've been consistent performers. That's why probably the 200 times move over the last 20 years, but the majority of the move came in the last 2 or 3 years.
Got it. Darshan, thanks so much for putting that into perspective. That's Honeywell Automation, and if you didn't know why the stock is doing so well in the last 1 month, well, maybe you will have some idea about this after listening into this. Look at it. This year, about 38-39%, but a slightly differentiated business model as well, as a result of which their gross margins, their EBITDA margins, as well as their return on capital and return on equity, much better than what some of the likely comparable peers in this space are like. Doing very well. Well, that's all that we have on First Word today, though. But lots more lined up on Indian Open. Vetri Subramaniam of UTI AMC joins in with his thoughts of how he sees the markets in the near to the medium term. And earnings discussions with V.S. Parthasarthi of Mahindra & Mahindra and R. Shri Krishna of Hexaware Technologies. But after this break, a full tilt towards the immediate day's trade.